Hey everybody, welcome to the Thursday night financial thing investment live stream. Let me move the desk up a little bit. There we go. How's everybody doing? It is hot here in Orlando, Florida. I think it's about 92 degrees Celsius, 1,000 degrees Fahrenheit. It's hot. So hot. I'm having internet problems here, so as last week I was not able to bring you the stream because my internet went down, and then today my Wi-Fi goes down, so this is the view from the outside window, which is not working because the Wi-Fi is not working, so all you see is black. But trust me, it's blue skies, clouds, a little bit of a breeze. Very hot, extremely hot. So I hope you are having a good week. Thursday, July the 10th. Can you believe? We're almost at mid-July. Just time seems to really zoom. What are we going to talk about tonight? Well, tiny little bit of news to look at. It was an interesting news story that was posted on the Alternative Credit Investor about average recovery default amounts that the European peer-to-peer lending aggregator Bondora had released the numbers, and it was quite surprising. So we're going to talk about that. We'll go through the collateral peer-to-peer lending update that they sent through. I'll be honest, I have not read through this document, so I thought it'd be fun to kind of go through it and see where the collateral administration is, what's going on with that. We'll talk about some other peer-to-peer platforms, what's going on in the mailbag. Got a couple of interesting emails over the last couple of weeks. One about peer-to-peer lending and one about the investment behemoth vehicle that exists, and we'll talk about that. Stay tuned. We'll take a look at the trading 212 portfolio too, as the stock market continues to rage up and away, which who'd have thought it, huh? In this day and age, in these times, with all of the economic and political things that are going on in the world, the stock market continues to roar forward. Because I've always said it, Tina exists. Tina is out there. Tina, there is no alternative now. At this point, real estate prices have skyrocketed, interest rates falling. Money is plunging into the stock market. This is exactly what we thought would happen. So we'll chat a little bit about that and look at the trading 212 portfolio, see where it is. So yeah, that's it. That's what I got for you. Hello, everybody who's in the chat. Stephen Hailing, Nottingham. And please give the stream a thumbs up if you can. You know why. Subscribe, you know why. Subscribe to the channel. Paul Bagworth is here in a lovely evening in Kenilworth. I bet Kenilworth is lovely at this time of year. Anna Boniron from a warm and windy España. Hola, ¿cómo está? Colin Perry from the Sunny Peak District. Mike Powell is here. And Chippo Naughty is cooking in Cambridge. What are you cooking in Cambridge? Are you just cooking in the heat, or are you actually cooking some pie and chips? Aki Chap is here in Accrington, of course, so thank you again for joining. Let's get right into it. No point in standing on ceremony, as they say. Yes. Well, hang on, let me share my screen, because that's what we do. The wonders of technology that can be a real headache too. Have you noticed that technology is supposed to make our lives easier? Sometimes it just creates more of a headache. Here we go. Bam, look at that. Bondora reveals average recovery on defaulted peer-to-peer lending loans. Estonian-based peer-to-peer lending platform Bondora has revealed how much principal is typically recovered on a €1,000 or £860 loan that reaches default. The firm said it typically recovers the following: Estonia, €667, Finland 689 euros, Latvia 667 euros, and the Netherlands 667 euros. Very, very interesting how those numbers are so similar, right? But the projections are based on a 10-year period, so this is a very historically deep data. In the first 3 years after default, we typically recover between 31% and 54% of the outstanding principal, depending on the country, Bondor says. These repayments accumulate gradually year after year through our structured recovery efforts. The firm added that it typically contacts customers who miss payments long before the loan officially defaults, which helps around 97% of customers avoid immediate default. So, looking at these numbers, if a loan does default in these countries, you could say they're pretty similar, right? Estonia, Finland, Latvia, and the Netherlands. The typical loan lender is going to lose about 33.3% of their loan value, which is really quite a dent on returns. If you're only getting 667 euros back on a 1,000 euro loan, it means you're taking a pretty big hit. Now, hopefully the idea is that one diversifies enough to where you're not actually plunking down 1,000 euros on each loan. And if you are, you're putting, you got 50 loans out there, so it means that only a small percentage are going to go into default. But this just shows the power of diversification. I had a friend of mine that decided to dip his toes into peer-to-peer lending about a year ago, and he did not grasp the concept that I was trying to teach him about how important it is to diversify. In fact, he just didn't want to deal with the hassle of picking out loans, so he decided to hop right into one of these platforms, and he put down £1,000 onto one loan, and that was all he invested. Well, guess what happened? The loan defaulted, and he is now not getting any interest, and he will obviously at some point either get his money back, part of his money back, or take a loss. And this goes to show you here on this article how important diversification really is, because if you were just to take 1,000 euros and plunk onto one Estonian loan on Bondora and it defaulted, you could expect to get back. And this is a good case scenario, but I think it's an average 667 euros. You'll lose 33/34%. So always remember, diversify. It's extremely important. Let's look at this collateral update. Again, I have not read through this update. I received it. For some reason, it slipped through the email cracks, so I wanted to go through and just take a quick look. So some of you have probably already read this. I'm not going to go through all the terms. Let me grab my drink. Hold on. Got the old green tea today. The matcha green tea powder, if you haven't tried it. Doesn't taste the most pleasant, but apparently it's supposed to be 100 times more antioxidant than green tea bags. So just a health tip of the day. But let's see what creditors need to do. I think that's old if you haven't already registered as a creditor for this administration. I think you're probably pretty late to the game. Progress in the period. So what period are we looking at? 10th of May 2024 to the 9th of May 2025. So how much progress have they made with this administration? For those of you that don't know about collateral, this was a defunct peer-to-peer lending platform that I did have the pleasure of investing through, where the two owners were found guilty of fraud. Basically, I don't want to get into the whole story, but basically a fraudulent setup that was purported to be operating under the FCA guise turned out to be untrue, and most people who invested losing a good part of their investment money, myself included. I was one of the lucky ones to get in here very early. But anyway, this is an administration. Some of those funds are trying to be recovered. Bank interest. Now, this is progress or progress. I forgot how to say it in England. How do we say it? Progress? Progress in the period. Asset realizations. They've scored themselves £22,479 in bank interest. Sundry refund. Who cares about that? This is the most important thing. Asset realizations. £126,794 was received in the period, representing the net proceeds received in respect of chattel assets sold at auction by the joint liquidators' agents. The allocation of the proceeds between the relevant chattel loans is currently being finalized. A further sum of £999 was received following the final reconciliation of proceeds obtained from previously realized properties. Our previous report set out the details of the two loan books operated by the companies. Recovering the outstanding loans has remained one of the key areas of focus in the liquidations. In our last report, it was advised that the loans listed in the tables below had been realized. Now, on the surface, some of these loans don't look like they fared too badly. We've got this one, Old Road, Bromyard, Hereford. The principal loan was $210,000. The amount recovered before costs was $212,000. So not a bad result. We got another loan here, 105, principal, 120 recovered, and then 74 and 94, and so on and so forth. Even this one, $595,000, Meadows House in Fulham, recovered $720,000. They actually managed to recover more than the loan. But now as you dive a little bit deeper into these numbers, you start to see some of these loans that did not fare as well, like this one in South Yorkshire, $294,000, that only $212,000 was recovered. And then it subsequently gets a lot worse. You got £311,000 loan, a little bit better on that one. A £934,000 loan that only $440,000 was recovered. Then this stinger, almost £4 million loan, only $800,000 recovered. And terrible, probably obviously the worst one down at the bottom. And I like the way they put it at the very bottom. So you start reading this, you think, oh, recoveries, this isn't bad. We're getting some money back on these loans until you hit this doozy at the bottom. £5.19 million Great Moore Street Bolton loan, recovered $1.4 million. For a grand total of all loans, £11.8 million of total collateral loans and £6.62 million recovered. So a little bit more than 50% recovered. Yeah. I always try to be positive, I think, well, it could be worse, right? This number could be £2 million. They could have recovered 10%, but still not great. Let's see. Interestingly enough, it says here the net proceeds from the sale of the Great Moore Street property are currently being held by the joint liquidators' solicitors and will be transferred to the liquidation estate once the final cost reconciliation has been completed. So another £1.4 million going back into the estate of the liquidation. And so let's keep going through here. It talks about chattel loans, small realizations there, net receipts from the chattel loans, £126,000. Got some money in the bank accounts, $383,000 and $429,000 that the Curry brothers were not able to get their filthy paws on. Those have been held, or they were held at the CUKL office and were recovered. As previously reported, the company's directors were unable to provide any explanation for the discrepancy in the client account balance. Investors who held funds in the client accounts have since received a first and final distribution of 93.79%. So if you had cash in your collateral account, you got 93.79% back. The joint liquidators have a duty to investigate the affairs of the companies, blah, blah, blah. The FCA commenced criminal proceedings against the directors who were ultimately convicted of fraud and money laundering. The FCA commenced confiscation proceedings against the directors, and distribution was paid to investors by the FCA in 2024. Along with a little bit of a bonus on top that the FCA paid for people who complained to the FCA about this situation. They gave, I think I received £500 for that. Talks about the creditors here. Let's see. They will continue to utilize an internal time recording protocol to split time charge. So this goes into the charges, and this is where we see what is going to happen following. So future actions here towards the collateral liquidation. The following matters will be undertaken before the joint liquidators can conclude the liquidations. Realization as far as possible of the remaining property loan assets, and then complete cost reconciliations, liaising with the FCA, payment of further distribution to investors if there is any money left, liaising with the committee who is fighting for our rights, and then reporting in respect to the liquidations. It is not yet possible to estimate when all these matters will be fully concluded. I would think probably another 3 years. We'll see. Then it goes down into the juicy part, which is the costs. Like how much is the liquidator billing? Whew. Let's see. Look at these payments. Legal fees, trust and non-trust, £500,000+ legal disbursements. Joint administrator fees in the trust, right down here, and non-trust, another 597,000, 587,000. That's a lot. Joint liquidator fees. Look at this, £1.05 million. Whew. Fees are expensive. They're expensive. 2.86 million, if I'm reading that right. Is that right? 2.86 million to run this administration down. So I was asked recently, why do these administrations take so long? Why do they take so long? Well, it's not hard to see. For anybody that's ever had dealings with a solicitor, one will know that solicitors bill by the hour. And it is in a solicitor's best interest to keep a case going as long as possible. That's why the solicitors love litigation, because litigation is an open checkbook for the person who is having to do the litigation. And it is not in a lawyer's best interest, at least some of the mid-ethical ones. It's not in their best interest to wrap up things as soon as they can. It's in their best interest to drag things out. This is why we see these administrations lasting for 5, 6, 7, 8, 9, probably 10 years. Now, I'd like to think that administrators are good, upstanding, ethical people that would like to get these administrations wrapped up, but I can't help thinking when they have open checkbooks, this is being paid by the estate, the liquidation estate. I can't help thinking that they do want to keep these administrations going as long as possible. And if you'll recall, when a lot of these administrations started to come, this is back in the Lendy days and the funding secure days, the money thing, I said it would take probably 6 to 10 years for the administration to wrap. Have we seen any administrations wrap up? We've seen some very quick ones like Growth Street, who I consider to be very ethical liquidators. Now, of course, a little bit of a different administration because that was one that they chose to do. Obviously, collateral is a non-choice one. Funding secure, non-choice. Money thing, non-choice. Wellesley and Co., non-choice. So they take longer. But I think that ethical administrations can be wrapped up in a quicker time frame, depending on, of course, how complicated the loans are. But this collateral one is a complete mess. And I think it will probably take, I don't know how long. We've been working on this now. It's probably been 5 years, maybe 5 years. But I think another 3 would be what I would expect. And with minimal monies coming back to investors because of the high cost of the legal fees and administration fees. Again, runs back to the point of why it's so important in peer-to-peer lending to be diversified, not to put all your eggs in one basket. Do you imagine if collateral was your only investment, boy, would you have gotten burned. And I do know some people who were very trusting of the Curry brothers and invested all their money into collateral and lost most of it. Let's go to the mailbag, shall we? Should we go to the mailbag? Is that okay? Let's do it. This is a good question because I think it goes along with what we've been talking about. Hi, Lawrence. I hope all is well. You had a good trip home. I did, thank you. Do you still think peer-to-peer lending is worth it? This is the question I get asked the most. I can get 4.5 interest through 4.5% interest through Revolut on an instant access savings account. Seems to me the marginal amount of interest that I can get in lower risk peer-to-peer loans are just not worth the risk. What are your thoughts? Cheers, Baz in Cambridge. Another Cambridge guy. Well, I think the question here, and hopefully Baz, you get to watch this. He did give me the okay to put this on the stream, by the way, in case you were wondering. Let's see right now. Let's have a look at Money Supermarket and see what we can get. Let's go to Easy Access Savings. Compare savings accounts. Now, fixed rate savings accounts, just terrible deals, right? The only reason you would want to take a fixed rate deposit is if you think the interest rates are going to continue to fall. I don't think in the next 6 months we're going to see interest rate cuts. So let's look at Easy Access. Some of them have really weird terms, like this one's 5% with Chase. It's a boosted rate. So you get 4.89% gross with a 2.25% 12-month bonus. That's a pretty good rate. So you can get 5% for a year through this Chase savings. And then let's go down to, this is a wacky one, Atom Bank. Get a reward rate of 4.7% in the months that you don't withdraw anything. So if you don't think you need your money, that's not terrible. Let's see, Revolut is the one that Baz was talking about. 4.5% interest, variable, up to 200K. No weird terms and conditions on that one. Pretty good rate, right? So if we go to, say, what I consider one of the lower interest rate options, the low risk peer-to-peer lending options, you can get 5.1% daily access, up to 20 grand. You want to put more in, you've got to go with the premium account at 6.1%. Which, by the way, I think that's a good thing that LoanPad did, so they don't have too much money in this classic. If they're limiting investors to 20,000, it means if there is a run on the money, that it's not huge chunks. Like this one, the premium up to 250,000. It kind of makes people think twice about withdrawing. Obviously, they have to wait 60 days, so it gives LoanPad time, if that were to happen, to get their finances sorted out so they could not be under financial duress. But if we're looking at this 5.1% rate here, as much as I've loved, I still continue to love LoanPad, you're only getting a 0.6% hike on your interest rate through this peer-to-peer. You're not FCS protected. If we look at a compound interest calculator about what 0.6% is going to do to you if you had, say, 5 grand at an annual interest rate of Revolut, 5%, let's say we do a year, we're going to end up with 230 pounds of interest, right? So if we were to do LoanPad at 5.1%, that's going to give us 261 pounds of interest. So for that loss of protection of FSCS protection, that is worth 31 pounds for taking that extra risk. Now, if you go up to the 6.1% interest rate, it gets a little bit more interesting. Now you're at 308 pounds versus 229, so 330. So you're getting, what is that? It's 80, my math is right, 80 pounds more, which is pretty good. That's pretty good. And I think that rate, let's do 6.1%, because that's actually what the peer-to-peer lending is offering, 6.1%. So you're getting 313. So that extra risk for the 60-day access gives you, I think, a better value for money. Now, if you're going to places that are offering 8%, now you're talking even more. Now you're up to 415. So almost 200 pounds more in interest. And I think this is where peer-to-peer lending then becomes worthwhile. When you're getting those 7-8% rates, you are almost doubling your interest Man, if you start combining that for 10 years and compounding it, it's a really, really good deal. So is peer-to-peer lending worth it? I think in some cases, yes. And I think in some cases, probably not. But what is going to happen is these interest rates like these ones at Money Supermarket they're gonna drop, right? Over time, you would think they will continue to drop. I know some of the savings accounts that I have dropped down into the 3.7% rate. And really, honestly, for me, it's a pain having to move things around. It seems like some of these banking companies offer these low rates, and then 3 months later, they'll change them because they're all variable. You see, these rates are variable. And I feel like what they do is they get people to sign up unless they're on a 12-month extra. Like this Chase one, I think, is a good deal because it gives you a 12-month bonus, which is cool. But some of these other ones that don't give you bonus lock-ins, I feel like what they do is they offer these really decent savings rates and then drop them 3 months later to 3.9 or 3.8. Now you have to move your money around again. And who wants to have 10 different savings accounts figuring out how to get 0.5% more interest? I think it's a pain. And that's one of the benefits, and I think where peer-to-peer lending becomes worth it. You can get better rate options that are locked in for longer periods of time. Of course, we've seen a bit of a drop in these loan pad rates from 6.5 down to 6.1. But this 6.1 has been that way, I think, since February of this year. So we've had very much April, June, July, 5 months of that 6.1% rate with good liquidity. So this is why I use the 6.1. That's why I use the premium account. I don't think 5.1 for me is enough to take that risk when I could get a savings rate of around 4.5%. But there are other companies that do offer better rates. So in answer to Baz's question, is peer-to-peer lending still worth it? I think in many cases it is. For those people that have been burned by companies like Collateral, they ran away a long time ago and they would say no. I think they believe that having a savings account is very, very safe. And some people just don't want to take the risk. And I can't blame them. I mean, how can you blame somebody? I've taken some pretty big hits in the administrations. And I guess I'm still a glutton for punishment where I still have some peer-to-peer lending. But it's definitely, when I got this email, it made me really think about what the future is and what do I want to do. So Cufflink recently, my 1 year auto product, I had it, I think it was at 9 or 10%, came up for renewal. And I thought, do I want to renew it? Do I want to get locked into another year at 8%? And I didn't make a decision. I wasn't sure. I just left it. The money sat in the cash account while I try to figure out, do I want to take another 1 year fix with Cufflink? It's a good question. Some of the other things give out LendInvest. LendInvest right now, I think I'm getting about 5.7%. And I just think maybe there's better places to get better returns. There's probably better peer-to-peer lending options out there. One of the reasons I stay invested in some of these companies is so I can look in the back end of the thing, see what's going on with the statistics. I do it for the website and I do it for you guys. But, I was looking, I don't have a lot invested in LendInvest. I'm going to show you my account. LendInvest, of course, strictly not peer-to-peer lending. We all know this, but here we are. This is my account. You can see I've got about 737. I started at £500. I threw £500 in here years ago. So up to 737, but 5.91%. I just think I can get better than 5.91%. Even just throwing it in the stock market, putting it into something like Bitcoin. I think I'm going to do better than 5.91% over a year for sure. So it's lead me to start thinking, do I want to even keep funds inside LendInvest anymore? I think they're very stable. I think the investment has been fine. The 5.91% isn't mouth-watering at all, especially for me who has a bit of a greater risk tolerance. So I've been thinking about, maybe shifting things around, maybe pulling some of the funds out of some places. Right now I have a decent balance of funds in LoanPad that I need temporarily to be held there, but once those funds are paid out, when I need them, I don't know if I'm going to hold such a big balance, because I've just been looking at other things going, I don't know that peer-to-peer is providing the greatest returns. Now, I'll always have some money in these platforms where I think it's worth it, but I don't know that I'm going to be holding big balances there anymore. And by the way, to me, what is big to you may be small. I'm talking about 4 figures, low 5 figures for me, usually 4 figures. So yeah, I think it's worth it. I think it depends on your risk tolerance, liquidity, what you need for liquidity. The stock market is not a good place if you want to do short term and you need short term liquidity. For example, I'll give you a good reason. I know I'm gonna have a tax bill to pay at the end of the year, where I'm gonna need some liquid cash, and I don't really want to hold it in a savings account because right now it's getting about 4%, but I don't want to put it in the stock market because 6 months, if I put money in there, it could quite easily go down in value. So peer-to-peer becomes a good place to store shorter term money that you might need in the future. And I think that's where it really does become worth it. I don't know. Let me know what you think. What is your strategy with peer-to-peer at the moment? Do you still continue to remain invested? Do you think that maybe the rates they're paying right now is just not worth it? Of course, there is just so many different options too. These companies are paying different rates. You can get one rate in Cufflink, you get a lower rate in Easy Money or LoanPad. So I think too, people get a little bit overwhelmed with all the different choices. I think there may be around, I don't know how many now, 30, 40 different companies that you can invest through. Anyway, I was reading the Peer-to-Peer Independent Forum, and I thought this was an interesting thread. It said fresh funds for peer-to-peer. This was back in 2024 in September. No question, peer-to-peer is a checkered past. I think that's a good way to put it. Lost out badly on lendy money things, suffered hugely on abundance and assets to be decided. So assets capital doing better on Unbolted, LoanPad, Cufflink, Elfin for now. But knowing all we know now, is there any way you would still allocate fresh funds to? I'm de-risking from the stock market and have some spare capital, debating on whether to put some into peer-to-peer again for the first time in a long time. So it kind of goes along with what we've been talking about. Now, Jester, de-risking from the stock market, back in September, that was a bad move. The stock market has been racing forward, but hindsight is 2020. Some of the comments are interesting. I'm not intending to put any more in, but LoanPad would be my only choice. Gradually moving my assets capital ISA funds there when they are available. This guy, Nomad, says, I'm adding to Capital Rise Capital Stackers Quanloop, that's in Estonia, Somo, and Wise Alpha running down the rest. And then seems to be the same kind of companies: Assets Exchange, Axia Fund, Capital Stackers, Capital Rise, Crowd Property, Crowd Stackers. Goodness, he's got a lot. So, and then I skipped forward to 2025. I wanted to see what people were doing after that fact. Here we go. Jester said, in June 2025, it's a new tax year in the UK. Following more withdrawals from assets and money thing wind downs, I'm interested in adding to my peer-to-peer portfolio. I'd like one new platform ideally, and then existing portfolio: LoanPad, Elfin, Cufflink, Unbolted, Crowd Property, which he is drawing down, Abundance, Disaster, Assets Wind Down. And Liso says, or Liso, whatever, Easy Money, been with them a few years. Will Smith says this is a problem in peer-to-peer, finding enough decent peer-to-peer companies to spread your money around. And we got our own Chimpo Naughty's on here. It says Lendwise likes that. And it seems to be easy money, Lendwise. That's where people would put new money. So, question to you, are you guys putting new money into peer-to-peer? I'm not at the moment. How good are the peer-to-peer lending wind-down plans? This is again goes back to the administrations, and it's interesting to see how good the various wind-down plans are or were. This guy Ace says some very good, growth streak, connective lending. Some are very bad, able rate and lending, somewhat in between. The main difference appears to be the honesty, integrity, and professionalism of the platform owners rather than the actual wind-down plans. Needless to say, the FCA has been less than helpful throughout. I think that's really a great point, because what good is a wind-down plan if the owners of the company are doing what Collateral did, which is thieving money, right? You can have a document illustrating you're the most perfect wind-down plan in the world, but if the directors are pocketing the money and stealing it, it doesn't matter. That wind-down plan is useless. Growth Street, I remember, had a great wind-down process. It was so fast. It was great. Everybody got their money back. And it was because the owners were good people, right? So I think that's a great point. Let's see what else. What else we got? This is a great tweet that I found on X. An average on a $650,000 US dollar portfolio of 8% annual return would be $1,000 returned every week on average. You can't convince me that index fund investing is boring. This is what I've been trying to hammer in on this stream and on my website. Index trackers are the way to go for 99% of people. So just get your head around that. You can put this in pounds if you want. If you can get 8% a year annually on a £650,000 portfolio, that's going to give you a return of £1,000 on average every single week. Now, of course, most people can't get to 650,000. Some people can. Some people have more than that. That's a pretty good way to think about things. So if you're thinking about half of that, 325,000, that'd be about £500 a week. Pretty cool. Let's go to the Trading 212 portfolio. Look at this. Look at how we're doing here. There's going to be money to charity, by the way, which I love. 29,306 UK pounds. We have had a 1-year return rate of 15%, which I don't know how good that is compared to the S&P 500. We're going to look at that. And everything is doing pretty well. MicroStrategy now up 18%. You remember that was in the negative for a while. A big chunk of the portfolio in that, way under-diversified in this portfolio. It's extremely reckless, except for this S&P 500 allocation of 7,556 pounds, which is up 5%. Nvidia has raced forward. This is why they're saying dead people make the best investors, because they sit on their hands and do nothing. This is now at 60%. So you can see, if we look at a year, we dropped down to under $100 a share. And this is where I started to have those stupid, crazy thoughts about selling Nvidia because I was scared. And I thought, oh, it's going to go low. Oh, what if it doesn't come back? And yet, just sitting on the hands and doing nothing. Look at that. That's a beautiful thing. 26% in the last year. Amazon, slow and steady, up 16%, now almost 17%. And then Tesla, the dog of the portfolio, down 11%. You'll see here my Tesla holding. I trimmed it by 50% before earnings came out. I thought they were going to have a bad earnings report because of everything that has happened with Mr. Musk. There were reports of Europe sales down 50%. It just made common sense to cut the losses on that one And I'll show you what I did there. Let's look at the history. Where is the history? Oh, I can't find it now. Let's look. Let me go to the history. History. It used to be at the bottom. Oh, look, we got a 34p dividend from Nvidia. Very nice. Tesla, look, we sold half the portfolio back on July 1st. The price was £304. We took a £254 loss, so $304 was the price then. Let's see how much it is now. So it's gone up a little bit, but I don't know. I just wasn't feeling very good about Tesla. It's not really done much for, if you look back. Let's see here. I mean, look at this, 2021. So we're now 4 years almost in the making of this stock just not really doing much. Now, if you're able to get in these dips, January 2023, especially down here in 2018, you're good. But for me, it just feels like a very flat stock. Will they do well in the future? I'm sure they will. Can I find better things to invest in short term? Probably. So I decided to actually sell half the position and withdraw some money. Withdraw some money to give to charity, and that's what I did. So I took out, I think about £1,500 and gave $1,000. I think I gave $1,000. Yeah, I gave $1,000 to Forest Home Hospice in Poole and Dorset. Took some out, and the portfolio is still fine. Look, we're almost nudging again at £30,000, which is super cool. If you look at the 1 year return, let's look at the 1 year return of the S&P 500. See how we did compared to that. So the portfolio did 2 times as good. In normal circumstances, I just don't think I'm going to do better than the S&P 500 long term, but this past 1 year we did. We got very lucky. If we look at the max on this portfolio, 21,000 return rate of 416%. So extremely lucky. This is not skill at all. This is just basically gambling in some ways and trying to pick out what I thought was going to be good stocks with very little readings of financials and digging in. I just, I mean, like Amazon's kind of a no-brainer, isn't it? Everybody uses Amazon. I see people's cardboard boxes piled up outside their houses when I come to the UK. Everybody's buying on Amazon. They continue to build these massive warehouses, and I mean, it's kind of a no-brainer. Retail's putting shops out of business. Nvidia, AI chips that are powering all the computers in the world, most of them. Kind of a no-brainer. MicroStrategy, not so much of a no-brainer. This one is a custodial Bitcoin company that's extremely risky, very volatile. But if Bitcoin does well, MicroStrategy does well. And then to have some diversification here in the S&P 500 is a no-brainer. So not rocket science. I think this is the best way to go for most people. Just stick it in an S&P 500 or a index tracker and you'll be good. You don't have to worry about volatility, and you won't have to worry about losing 11% in a day. I mean, one of these stocks like Tesla could go down 15% in a day, as could Nvidia, as could MicroStrategy. So moving on, another mailbag question. Here we go. Lawrence, well, I hate to admit it, but I think you were right about Bitcoin. I've been the biggest skeptic. I had emailed you a couple of years ago telling you what nonsense I thought Bitcoin was. But as I look at the monetary system and the way Bitcoin has been performing, I was wrong. And I wish I would have invested years ago. Our government cannot help its reckless money spending and printing, and this isn't going to change. The dilemma is, how does one buy in at an all-time high? I think I want to buy some now, but it feels too late. Have any thoughts you can share? Feel free to use this email for your live show. Sincerely, David. One thing I will say that I don't know if I'm right. That's very kind of you to say I was right. Or I don't think there is any right or wrong. I think a lot of it is just guessing and using simple information to guess and to get in front of things, right? So I've always thought Bitcoin was a very interesting vehicle for investing. People still dismiss and thinks it's nonsense, but if I go to the very simplistic chart of this debt clock, and I'm watching these numbers, and these numbers are accurate, I think they're probably a little bit better than the situation is accurate. But in the USA, $37 trillion of national debt. The UK, $4.2 trillion of national debt. These clocks are not going backwards, especially I'm looking at the US and UK, where I think, the US powers a lot of financial markets. Do I see any of these numbers going down? I'm looking. I'm trying to find one. Japan, are you going down? Japan's not going down. Is there anywhere? Argentina's going up. Every single one of these clocks is going up. Right? Every single one of them. Switzerland, are you going down? No. Okay, so none of these clocks are going up. So every single one of these countries is taking on more debt. Some of them are going up much quicker than others. Argentina, debt. Korea, debt. And there is no solution to this. The USA right now is beyond fixing when it comes to debt. And not to get too political or anything like that, but politicians, they lie about everything. I mean, we can look at what's going on in the US with the current political system promising certain things to get elected, ending the WAR in Ukraine. Didn't happen. Having a strategic Bitcoin reserve. It's going to be billions of dollars of Bitcoin purchased. Didn't happen. Getting the budget balanced to get the debt under control. Didn't happen. So, knowing that the political system isn't fixable, something like Bitcoin just makes sense. A place to store money that will increase in value and beat inflation. So I don't know that I was right. I could be completely wrong. But I do look at these very simple things that are happening going, well, how else are you going to have some kind of a store of value? You could use the stock market, of course, maybe. I don't know that you could consider that a store of value. But Bitcoin really continues to rage. We just hit an all-time high of 113,000 US dollars. Kind of a big day for Bitcoin. I don't know why. I don't know why it's gone up so much today. I think just the way the cycle goes. But a lot of these companies now are starting to realize that treasury of Bitcoin is better than cash. With inflation taking away pounds and dollars value, we now have 847,000 Bitcoins of a value of 91 billion US dollars being held by companies as a rather than cash strategy, which is Michael Saylor's company now coming in on close to 600,000 Bitcoins in their treasury. It's going to continue to happen. I just don't see any other option to get better returns on money. We've got even the London Bitcoin company now getting in, which I think you can buy shares of this. I think you buy shares now on Trading 212 in this. If you want to get some exposure, let's take a look. Again, please do your own research. It's not financial advice. I think this might be the only company that offers. Here we go. Ooh, look at that. It's not very good on the share market. 12.3p. look at that. Down 45% in the last year, so probably not a very good investment. But that, again, this is short term, so I like this, buying in the low point. I think you're better off just buying the Bitcoin itself, but that is one way to get exposure. How are they doing? 3 months, 1 month, struggling. This is a very small cap company too, so obviously there's going to be volatility. I'm not sure that would be the way to go. But if you are looking to just buy straight up Bitcoin, and also, yes, of course, nobody likes to buy in at the all-time high. By the way, I personally wouldn't touch this London Bitcoin company myself. I've read some things about the owners or the owner and director. I don't know if it's true, but there has to again be trust behind the person running the company, and this guy's got some negative stuff. But for 12p, it might be I like buying in the low points. I mean, how low could it really go? And if they are buying Bitcoin as a treasury and Bitcoin continues to do well, you could possibly do well. Not financial advice. We'll see. Oh, it's probably because of this issuance of shares. Maybe they're diluting too much and spooking the shareholders. But yeah, with all of that basic thinking and that this world debt clock continues to skyrocket, I guess you could go gold, right? I don't know. I guess you could diversify into gold. Gold price 3,333. Oh, look at that. Almost 33,3333. So gold has been doing well, but I don't think you're going to get the performance. How much are we up on a year? I mean, that's big. To see gold go up 40% a year is just kind of insane, because historically it's just not done that. You can see here, look at this, 2012, I don't know if you can see this, but 2012 it was $1,700 an ounce, and it took 8 years for gold to go back over $1,740. So you saw a decline all the way down to 1,000. So if you had the whereabouts and the smarts to get in down here, but what happens is a lot of people who buy in, right, to things like this, they won't stick it out for 8 years getting zero return. Most people, after a year or two of getting zero returns, are going to exit that investment. And this is the problem with gold. So yes, it's had a really good run from 2020 up to 2025. It's gone up $1,000 an ounce. $1,000 an ounce. So it's had a good run, but also had a flat 8 years. And it's also had periods where it's gone flat for a couple of decades. So that's the tough thing about gold. And again, you're coming in at the high. Now with the Bitcoin, is it too late? Look, there's always going to be an all-time high at some point, where I buy all-time highs all the time in the stock market, other investments. It's just the way it is. But if I look at the charts on anything, I mean, if I look at the S&P 500 charts, if I didn't buy all-time highs, let me exit out of here, then it would be very hard to get in at all, right? Why are you acting weird, Trading 212? Where's your menu bar gone? I'm going to pull up the S&P 500 stock. I'm going to show you the chart. The max chart. See, back here in 2021, you were at an all-time high of 64 pounds. One would think the same thing. Oh, I don't want to buy in an all-time high. And then it dipped and then went back. And now our all-time high is 30 pounds a share more. So you're always going to, at some point, be buying into an all-time high. If you believe in what you're investing in, it really shouldn't matter if you're a long-term investor. If you're a 1 year, 6 month investor, yes, it's risky to do it. If you're a 5 to 10 year plus investor, all-time highs really don't matter. Of course, everybody wants to buy in at the all-time low, but it's very difficult to do that. So for the most part, as normies, we have to just buy when we have money to buy. And I think Bitcoin is no different. Now, if the Bitcoin price goes to 250,000 or a million, these 113,000 prices are just going to seem absolutely cheap. But again, nobody really knows. We don't know what it's going to do. So that's my answers to that, David. If you feel good about the product itself, you feel good about Bitcoin, you want to go, there's just no way to time it. I think the best thing to do is just buy when you have money. And if you have extra money 6 months from now, buy some more. Maybe that price is going to be 130, 140. Maybe it'll be 90. I don't know. Nobody knows. If anybody tells you they know, they're full of it. They don't know nothing. So I just remember that debt clock is not going backwards, which is pushing money into things like Bitcoin and gold. So there you go. Okay. I think that's all I got for you. Let me put the cami on. Hope you enjoyed the stream. Hope you enjoyed it. Please hit that thumbs up if you can. What time is it? Oh wow, we've almost gone an hour. I'll see if you have any interesting comments. Yes, evening from muggy Midlands. Why don't you switch the fan on behind you? It's so hot. Well, I think it's a bit distracting, the thing whizzing around in the background. Revolut has a fee. Due to Revolut savings account, only 2.29%. Okay, so there you go. Stephen Hale has some cash drag in Easy Money. Tesla is currently a seesaw between the excitement of robotaxi versus the idiot in charge. Spiked on the former, and then Elon announced a political party. Yeah, I think he needs to stay out of politics and just focus on running his companies. So, very idiotic. I agree. I like the car, though. It's a good car. Now, no matter what you think about the person running the company, he makes a good car. It's a good car. Very interesting car. So anyway, I think that's going to do it today. Thank you for joining, and hopefully we'll have the Wi-Fi sorted out next time. We'll see. Have a great weekend. Please, again, subscribe if you're not subscribed. Consider becoming a Patreon member. Thank you to everybody who's a Patreon member. Really appreciate your support. I'll see you next time. Enjoy your weekend. Hopefully it doesn't rain. That is all I got for you. I will see you later. Take care. Bye.